All right, it's a pleasure to be back in Vancouver for the Metals Investor Forum. My name is Robert Sinn, and as you can see, I'm pretty tall. So I'm going to do my best to try and speak into this mic. I had no idea that Brian was going to talk about copper and gold, so he stole a little bit of my thunder, but that's good, because when I practiced this presentation, it took me 30 minutes to get through it. So we're going to go really fast. I'm going to make sure you guys walk away with the salient points here. We have the stock shaman in the front row. Quite a high-level audience here, so I'm going to go fast because you guys probably know all this stuff already. Forward-looking statements. I like what that CEO said, that the only thing I can assure you of for sure is I'm going to make some forward-looking statements. The rest of this presentation will be trying to predict or forecast two pretty hard-to-forecast areas of the financial market. So two metals for the 2020s, the red metal copper, the yellow metal gold. And you can see I have the flag of the country of China, the most populous country on the planet, and basically the most important driver of these two metals, copper and gold, both to the upside and to the downside. If you knew what China was going to do in the market, you'd be a billionaire. Some quotes. I'm not going to read them all. You can read them. I like the J.P. Morgan quote and the Herbert, Hoover quote. Gold is money and everything else is credit. And, Hoover was the founder of the FBI, and he says that we can't trust government. That's why we have gold. I think that's a pretty powerful statement from somebody who basically formed an organization that is quite powerful and cannot always be, up to good things. And then the Rumi quote. We could always use more love in the world. And through love, all that is copper will be gold. And then Yogi Berra, it's hard to make forecasts, especially about the future. And if you want to make a fool of yourself, just get on a stage in front of a packed room with cameras and make some forecasts about financial markets so you can laugh about it at a later date. So that's what we're going to do today and have some fun with it. I'm pretty optimistic on copper and gold in 2024 and for probably a few more years after that as well. Copper is the metal of human progress, the green transition. Everybody here knows about the green transition. We've heard it. We've seen all the slides forecasting how much copper that we need 10 years from now, 20 years from now. I'm not going to get into that stuff because it's gone over and over again. Most likely it won't be exactly like all those slides and graphs tell us it's going to be, but I think it's safe to say that we're going to need a lot more copper. And then gold is a timeless store of value with no counterparty risk. Gold is truth in a world full of lies and some other words that I won't say here. In investing, simpler is better, cutting through the noise, focusing on long-term secular trends. The way we usually lose money or make poor choices in markets is we get swayed off of the trend because of some noise, some news headlines, somebody that we respect told us something and we decided to get out, right? But stick to what works, and long-term secular trends work. Both gold and copper benefit from strong tailwinds. Now, I'm a technician, and I look at this 9-month chart of copper, and I scratch my head. Not really a trend here, guys. I don't think that you can see one either. It's down, up, down, up, down, and recently we've been going down. Friday, copper had a little bit of an uptick, about 1%. But I really look at this chart and I think $3.75 a pound copper is an incredible opportunity here. And I think it's one that we might, look back on 6 months or a year from now and say, yeah, $3.75 was a good entry point in copper. So why is copper traded poorly in 2023? I think a lot of it has to do with China. China's had a property bubble that has burst, and there's a lot of aspects of the economy, the manufacturing side of the economy, that is not strong. If you look at the Philly Fed data, the Empire State data, all of these data points are very weak, and they've been weak for over a year now. So, if I look at this chart, we're at lower levels than the 2008 financial crisis. Yet we hear the job market is very strong. In the US, we have full employment, and we're going to have a soft landing. So there's a lot of data points that don't really jive with one another. And I think that the manufacturing side of the economy has been weak, and that has hurt copper in 2023. Also, a lot of tightening. The Fed has gone from basically 0 to 5.5% on the Fed funds rate. They've drained their balance sheet about $1 trillion+ in the last year and a half. That's a big headwind for something like copper and even for gold. Monetary metal like gold. But I think that we are at a key inflection point. Maybe right now, maybe 2 months from now. It's hard to get the timing exactly right, but I think that the People's Bank of China, very important driver in both the copper and gold markets, they are going to inject stimulus, a lot of stimulus in 2024 because their economy is really hurting right now. And I think the Fed is also going to start cutting. Now, the Fed and the timing of the Fed rate cuts is a bit controversial because, just in October, we were thinking the Fed was still going to hike further. And then the market caught wind of, no, actually they're done and they're going to start to cut rates, right? Right now it's about 50-50, a coin flip on whether the Fed will cut in March. And the possibility of a May cut is about 90%. But March is about a coin flip. In my opinion, we are about to start a major monetary inflation in the first half of 2024, and this is after 2 years of tightening and negative growth in the supply of money. So it's an uneasy calm in copper. I'm not going to go through all this because, again, I have to go fast here. But I think the main takeaway on copper is the supply side is extremely challenged. Extremely challenged. The mining industry is not good at increasing its output, okay? So the real challenge, so this is from Bank of America, and you can see 2024 was forecast to be a small surplus, and this was like a month ago. And then Cobre Panama happened, and I'm going to show you another forecast that's going to show it's already swung to deficit. But look out to 2026. Balance, minus 886,000 metric tons. That's going to be over 1 million, metric tons as of today, just based upon what we know about Cobre Panama and some of the other large copper mines in the world. 1 million metric tons of copper is about $8.3 billion. Okay, that's a lot of money, a lot of copper. I don't know where we're going to find that much copper in just 2 years' time. I guarantee you the mining industry is not going to find it that fast. All the big copper miners, Freeport, go down the list, Teck, they're all missed their guidance in 2023. The mining industry is having a really tough time right now with big cost inflation, labor challenges. People don't want to work in this industry. The industry is getting older, quite a bit older, and if we actually look out 5 to 6 years from now, there's a situation that might happen in the mining industry where we just don't have enough people. We just won't have enough because not enough young people are choosing this sector. Codelco, largest copper producer in the world, worst year in a quarter century in 2023. Cobre Panama, this was a real punch in the gut of the copper market. 1.5% of global output, so 1.5% of 22 million metric tons offline in like 2 months. It happened very fast. They were talking about it. There were some protests. 2 months later, done. Government says you've got to close up shop. And that's offline. So grades continue to decline. So one thing that we know for sure, one of the few things that we know for sure in mining is average grades will always keep falling, both in gold and copper. All the high grade stuff that's super, near to surface has been found already. We've got to go deeper. We've got to go to more far-flung places to find it, and we're going to have lower grades. And lower grades means higher costs. Here you can see ore grades and the production costs. So 1.5% copper grades is out of this world in 2024. That would be a pretty good mine if that was the average grade. But most new mines coming online are 0.5% average copper grade or lower, a lot lower. In Canada, there's a bunch of massive copper mines that have 0.3% grades. Robert Friedland, everybody knows Robert Friedland. Everybody knows he's good at talking his book, like a lot of us are. He says we need $15,000 a ton copper stable for a long period of time before the industry can actually get those new giant mines permitted and built. The built and permitted part is the really hard part. Finding them, kind of hard too, but it's actually a lot harder to get the financing to get them built. And as Brian said, 15% average cost of debt, that's a pretty high hurdle to jump over. This is a controversial chart because there's a shadow inventory in China. China's a little opaque, hard to understand everything going on in that country. But just looking at this chart, they destocked their copper inventories in 2023, and it's basically, they're at all-time lows right now. So their economy is sucking wind hard. They have drained their copper stockpiles throughout all of 2023, and now their central bank is injecting stimulus back into the economy to try to spur growth and try to spur inflation. Seems to me that should be pretty positive for copper, and eventually China's going to restock. Positive catalyst. So this is from Goldman Sachs, and this is like up to date as of the last week. You can see Cobre Panama there, the red. Complete shutdown of Cobre Panama, we're at a 550,000 metric ton deficit in copper in 2024. That's a big number. In 2025, it'll be 700,000. And in 2026, it will be more than 1 million. That's a lot, billions and billions of dollars of copper that the market's going to have to find. And the way to find it is to make the price of copper go higher to incentivize that new supply to come in. So I'm pretty bullish on copper, as you can see. Now let's talk about gold. Salient point on gold, the looming monetary inflation. So rate cuts haven't started yet, but the Fed has been on hold for 5 months. It's unheard of for the Fed to be on hold for 6 months or more and to hike again. Okay, it's basically never happened. So they're going to cut. We just don't know exactly when. My bet it will be in March, that we'll get a 1/4 point cut from the Fed in March. And a little bit of a surprise, they're going to tell us in March that they are going to taper the quantitative tightening. So they've been shedding their balance sheet over time gradually, and it's been $60 billion a month. They're going to cut that down to $30 billion. So that's going to be an extra $300 billion into financial markets as soon as they announce that taper. I think another really big driver for gold is deglobalization and de-dollarization. And just frankly, the U.S. Has lost some trust in the world. And I think that's an understatement the last 20 years. And whether Biden wins in 2024 or Trump wins in 2024, I'm American. I don't have a great deal of confidence in either of these men. And they both love to spend taxpayer money. And this is an election year. So we're going to have a massive deficit again in 2024. The U.S. debt to, the economy is 123%. In Canada, it's 107%. I hear a lot of people talk about in Canada, our debt is so high, our debt is so high. Well, in America, we like to do it bigger and better, and we love debt. We love our debt, 123% debt to, GDP. So de-dollarization is a very big factor, and the price of gold is being set in the East now, not in the West. 20 years ago, the price of gold was set in the U.S. Not anymore. Shanghai, the rise of the Shanghai Gold Exchange, China, the central bank of China, continues to accumulate gold. What happened in October 2023? There was this big drop in the gold price from September to October. Gold dropped from about 1970 to 1830 in a few weeks, and then it V-bottomed And a lot of people were really surprised by that V bottom. That gold went from 1830 to 2000. I followed gold every day of my life for the last 20 years, and I was surprised by how sharp that turn was. What happened? Yeah, it wasn't, about Israel. It wasn't about a terrorist attack. A lot of people say that, and that's just wrong, okay? That may have had some momentary price impact for a short period of time, but it had no net impact on the gold price the last few months. It was China buying. China put in the bottom. China accumulated a lot of gold at the 1800 level in 2022. As soon as it went back close to that level again in October, they stepped back in the market and supported price. Then in November, we caught wind. The market, figured out that the Fed was done and a pivot was at hand. And that was what drove it above 2100 about a month and a half ago. That was a failed breakout. Gold pulled back, and we're currently just above the 2000 level. But central bank purchases have changed the dynamic in the gold market, in the gold price the last couple of years. People's Bank of China. So China really stepped up its gold purchases in Q3 2022. They really started to hit the buy button. And I think a lot of that had to do with what happened, in Ukraine and with, Russia, and the fact that they lost their foreign, holdings. The gold price bottomed at 1625 in September, October, and China was a big buyer right at that time. So China is absolutely major marginal price setter in the gold market. Real yields. Gold, everybody for the last 10 years has said, if you know where the real yields are going, you'll know where the gold price is going. That has been a very strong correlation up until last year. And what changed that correlation? I think a lot of it had to do with the central bank accumulation. Major central bank buying throughout 2023, over 1,000 tons of gold. M2, so that's just showing the tightening in monetary policy of 2022 and 2023. And now we're going to flip from tightening to loosening. Debt deficit. So the U.S. debt deficit is at a point of no return. 123% debt to GDP. The interest on the U.S. debt alone is 20% of what we receive in taxes every year. The U.S. Treasury is paying more than $1 trillion in interest on the debt annually. $1 trillion. So it's a number a little bit above 34 trillion. The average rate of interest on that debt is about 3.2% right now. And it keeps going up because the yield curve has shifted higher. 10-year note yields 4.15%. Fed funds rate is 5.5%. 3-month T-bills 5.3%. So whenever the Treasury has to refinance, they're refinancing at higher interest rates. That amount is going up. The U.S. is, what the word I'm about to say. I'm not going to say it. Expect the red ink to keep flowing. 2024 is an election year. Politicians have no will for austerity. There is no chance for austerity in 2024. It's just going to be more red ink. I predict a $2 trillion deficit. The spending is absolutely out of control, and that is a very big positive for gold because it's going to force the Fed to pivot. The Fed has no choice but to pivot. Who cares about the jobs market? They need to finance the government. Soft landing. This is very controversial, and I'm just going to say I can't forecast the economy. If the Fed pivots, probably could be a soft-ish landing, but there's a lot of data out there that is not very positive. The payrolls every month, they're revised lower, totaling 500,000 in the last year. So every month, the government puts out this jobs report that's always better than expected, and then a month later, 2 months later, they take 100,000 jobs off, and it wasn't really as good. Seems to be a little bit of gamesmanship there. Fed forced to pivot. The BTFP will be extended in March. That's a little free money to the banking system that the Fed did. That's way beyond the scope of this presentation. And the deficit is out of control. And actually, if you extrapolate the trend and the rise in the US deficit, gold's going to 5,000 probably in the next 3 years. Too much treasury issuance forces the Fed to ease, and you can see March will be the taper announcement, and in April, they will taper. And this chart has gone around quite a bit. Every time the Fed stops hiking and starts easing, gold has 43%, 76%, or 54% rise in the last 25 years. And nobody owns gold. How many people in this room own more than an ounce of physical gold? I'm just curious. Okay, it's definitely less than half. So 0% of pro money managers surveyed have a greater than 10% portfolio allocation to gold. I think that's a pretty shocking number. And I did a poll on X, and 2 of 5 of my respondents, so 40% of 500 people that responded owned zero gold. I really think that nobody really has much exposure to gold. The sentiment continues to be so negative. I mean, I'm even having conversations in the hallway. People here are negative on gold. I think a lot of it has to do with gold miners, but it's important to set gold aside from a gold mining company. Investors, in the U.S. have been net sellers of gold. Exchange traded funds were big sellers in 2022 and 2023, but that's looking like it could start to flip back to buying, especially if the Fed cuts. I think that we will see that flip back to buying. That'll be a very positive. So I'm a technician. This is a Captain Obvious chart, but it's a very important chart because it's such a long-term chart. This is such a well-constructed long-term pattern. Over the cup was formed over 9 years, and the handle's about 3.5 years old. And gold continues to consolidate above that 2011 high at 1923. And even recently, even though it went to 2152, dropped back to 1980, it's still at 2030 here today. High and tight consolidation in a bullish long-term pattern when nobody owns the metal and 90% of people hate the metal. Not a bad setup. Oh, and by the way, if that pattern actually works, if it really does break out on a monthly basis above 2,100, it would target, depending upon the analyst you talk to, 2,700 to 3,000, but it won't happen in a week or a month. This is a 25-year chart. So it might take 2 or 3 years, but eventually it will get to $3,000. Conclusion. So the salient points are copper is supply challenged, and we're about to enter a major monetary inflation, and China is going to support the price of copper and gold and continue to accumulate and hoard gold, both the Chinese government and the Chinese people.